Gerry Fowler, Global Head of Equity Derivative Strategy at BNP Paribas. Hi, Gerry.
Hi.
So despite the news from the Fed, despite the news on bank stress tests, you say the market could fall 5 to 7%. Why?
Yeah, well, yesterday we saw a lot of news that was really some of the few tailwinds that equities have, particularly in US markets, where we're starting to run into some more significant headwinds. The reason for a modest pullback in the US market, or our view that a modest pullback is coming, is really based on the fact that there are a lot of headwinds still existing for equity markets, not the least of which is valuations. The US market is now trading above its very long-run average PE valuation.
What other headwinds are there?
Well, there's demographic headwinds, where you've still got a large chunk of baby boomers that are looking for safety of their money as opposed to any form of even modest return. You've got emerging market savers, which is where the future wealth of the world is coming from, who aren't particularly interested in equities. The companies aren't regulated, markets aren't regulated, they don't have pension funds. So there's a variety of factors. You've got very low interest rates, which are flattering the valuations of equities, and very high margins, which, while very attractive for equities at the moment, can't really expand much further, so are likely to face some pressure.
Because you say the valuation discount of equities will be eaten away, don't you?
It could well be, especially for markets that are trading above average valuation, so particularly the S&P. Some other markets are slightly cheap, and we think there's some nice risk-on trades to do in terms of convergence trades.
Talk to me about convergence, because you're using derivatives to take advantage of what you say might see a fall of the S&P and a rise in emerging markets. Tell us how this works.
Yeah, well, after the fall in the middle of last year, we saw a lot of markets fall very sharply, including the S&P. The S&P is one of the only markets, and high-quality stocks in general, actually, are some of the only areas of the market that have fully recovered their losses from last year and are now trading at either average or above average valuations. There are lots of parts of the markets globally where risk appetite hasn't fully returned. We're looking at the DAX, we're looking at emerging markets, we're looking at cyclicals versus defensives. So looking at derivatives trades actually helps you eke out, in our view, the last of this convergence now that there's much less profit on the table than there was a few months ago. So buying call options on emerging markets and selling call options in the S&P to capture that 5 to 10% convergence return.
And also long DAX calls, short Nikkei calls.
Yeah, DAX and Nikkei is an interesting one. The DAX is a cheap market. It hasn't converged it hasn't recovered its losses from last year. But Germany is also one of those markets that's getting a huge benefit from interest rates that are too low for its local economy because of the ECB looking after the periphery. Whereas in Japan, we're still unsure about exactly what the Bank of Japan's intentions are with this inflation targeting. But nonetheless, at least at the moment, the monetary policy in Japan and interest rates are actually too high for the Japanese economy, and it's a much more expensive market.
When you're looking at industries, it's interesting. You talk about this disruptive phase, how technology is changing the game. You've got threats from regulators, you've got threats from politicians. And when you strip it all out, all those factors influencing various industries, you say only two are left, technology and industrial. So is that the place to put our money?
Yeah, we've had 20 years of tailwinds for equities, whether it's deregulation, people levering up, stagnation of real wages. A lot of those are coming to an end, and in lots of areas now you've got increasing regulation, increasing political risk, increasing deleveraging trends, and increasing technological disruption. Only in a couple of sectors do you not have that, and that's technology, where they're through the worst of the technological disruption, and industrials, where there's still a lot of demand for industrial goods and services. So they're starting to trade on premium valuations versus the rest of the market, but justifiably so. They're benefiting from the very high margins that we're seeing in markets at the moment.
Gerry, thanks for joining us today. Gerry Fowler, their Global Head of Equity Derivative Strategy at BNP Paribas.